So managing risk in microfinance banks, especially in this post-COVID era. Before COVID, there were issues that were major issues with us, and most of those issues are risk are usually around, most of them are around the businesses, turnover, capacity of the business and everything. But COVID brought a new dimension. Environmental factor came in, government factor came in. So there are a number of risks that one has to be on the lookout for in a post-COVID era. And even now that most businesses are beginning to adopt virtual technology or virtual method of carrying out their operations. So there are a number of risks that this will expose us to. But just specifically, these are the things we'll be looking at today: how you manage delinquency, and the global standing order instruction that the CBN just introduced in July, GSI, and fraud, as well as the implications of fraud on microfinance banks. So these are the three major things we'll be looking at. And to go to delinquency management, but let me just quickly ask, what I believe most of us have some years of experience in microfinance bank. But what do we understand by delinquency? Just one or two persons, just quickly. Delinquency, what exactly does it mean to have delinquency? Anyone?
Let's speak up, please.
Delinquent.
Okay.
Yes,
The collection.
You can go ahead.
Loans are installed. Simple as it is, loans yet unpaid.
Okay. Loans yet unpaid. Loans that are due, but not yet paid. So those two
loans
things are important. Due and not yet paid loans, simply put. Thank you so much, Sammy. So the delinquency management basically is how you can minimize the realization or the possibility that loans will become delinquent, that beneficiaries loan or applicants loan will fall due, and then the applicants will not pay. So basically you are trying to ensure that you avoid sitting on a live wire. As at last week Monday, let me use last week Monday, when the protests was still in the early stage, we all just thought it was just going to be protests and all the rest. And I'm sure a number of us would have still probably booked loan on that day, even up to Tuesday, Wednesday, we'll still book loan and then create a risk asset and say, oh, because we must meet our target. And you know that if you don't book loans as a microfinance bank, you don't have income. Major income line for microfinance bank is the risk, interest income on loans. So, but nobody foresaw, or maybe a number of people saw it coming, but nobody foresaw the turn of events as at 20th, which was Tuesday night, which then culminated into destruction of properties all over Lagos yesterday. And I can tell you that some businesses right now have lost almost all their investments. So that's a risk that manifested just within a few days. And it's possible that some microfinance banks loans would have gone bad within those 2 days, between Tuesday and today. It's possible that the loans that they gave out on Monday or created on Monday is completely gone, because the customer may have actually stopped the store and then the store has been looted completely. So these are risks. And so what we are trying to then look at is, how do we ensure that we avoid what is called the banana peel? If you see the image on the right side of the screen, you see a banana peel on the ground, and the lady wearing that high heel, if she's not careful, if she steps on that banana peel, what is likely to happen? She will fall. No matter how elegant she may look, that shoe looks like somebody, the leg and the shoe looks like the person wearing it must be very elegant. no matter how elegant she may be, no matter how sophisticated she may be, no matter how experienced she may be, no matter how beautiful she may be, if she steps on that banana peel, she's likely to fall. And so delinquency is also like banana peel in microfinance banks. If we allow too much of delinquencies, the microfinance bank can collapse. And that is why we are looking at managing delinquency. And then, so what exactly is risk? I'm sure that's not new to most of us. Risk is actually the probability that of an adverse event occurring. That's probability that something that is adverse to your business or to some outcomes may occur and affect your business. So risk is a form of uncertainty about outcomes that may have a potentially adverse effect on an individual or an entity. And then risk measurements, there are various ways to measure risk, but we don't want to go into all of that. So we just want to focus on delinquency management. But basically, you can first monitor the first dimension of risk you want to also consider at first is that what is the probability that the risk will occur? So probability of occurrence of that risk, sometimes you measure whether it is high or low or medium. And then what is also another dimension is impact of the risk if it happens. So first dimension of risk is probability of occurrence. Second dimension is impact if it occurs. And then third dimension is how do you then manage that risk? Is this something you can transfer? Is this something you can minimize? Or is this something you can avoid completely? So these are different dimensions of risk. But just to stay on track. Now, if you see this picture, the question is this man, that hand, or the man, whether it's a man or woman, we don't know. The man placing the hand in between those bricks, is he trying to prevent the bricks from falling, or is he protecting the ones that are still standing from falling? You can see that some are still standing and some are already falling. What exactly is he doing? Is he preventing the bricks from falling, or is he protecting the other ones that are still standing from falling? Anyone in the class?
Let's speak up, please.
Preventing.
Hello?
Yeah, Badrin.
Okay, B. Moraki.
Okay.
Please go ahead.
Go ahead, Moraki.
It's preventing the other bricks from falling. It's preventing the other bricks from falling.
No, hold on. So the question is he preventing the bricks, the ones that are already falling, from falling, or is he protecting the other ones that are still standing from falling?
He's protecting the other ones that are still standing from falling.
Great. Why is he doing that? Because those ones, the ones on the left side, they are falling already. And you don't want to have all the bricks falling. This is the same thing. We can liken these bricks to our loan portfolio.
Let's just wait a bit. I think his network is a little bit bad where he is. He'll be back on. Let's just give him some minutes. Okay, he's back. Okay.
So let me continue. Let me continue from where we stopped. Okay. So it's preventing the other bricks from falling. And I was saying that we can liken this to a loan portfolio. So when you are looking at your loan portfolio, how do you look at it? How do you even manage the risk? Do you look at it just holistically there with your entire portfolio? This particular portion is at risk, there's delinquency or anything? Or do you begin to even dimension the portfolio into sectors, into local government areas, into region, and begin to say that, oh, okay, this state, this is the portfolio, this is where we have most of the portfolios that are becoming delinquent. And so if I want to ensure that the entire portfolio did not become at risk, let me minimize my exposure to this sector. So there can be an approach where you divide your portfolio into sectors, education, technology, and then measure the delinquency rate for each of the sector and have a threshold. Have a threshold for your delinquency rate that you can just say that, okay, my delinquency rate must not be more than 5%. So any sector that has more than 5% delinquency rate, or let me just use the most common language that we use, portfolio at risk, PAR. If you have agreed as an organization that PAR should not be more than 5%, if you then dimension your portfolio into sector, any sector that already has PAR of more than 5%, you know that that sector is placed on, is watch listed until that PAR comes down. You don't do further disbursement. And you can liken it to this picture. You are preventing the other bricks across the other sector, because once you have one bad sector, you can just dilute your entire portfolio. So you are preventing it from affecting the other sectors. So you minimize loan. You can also do that by local government if you are a state microfinance bank. You can do that by region, even if you are a local government, a unit microfinance bank. You can divide your microfinance bank in the area of operation into region and say, oh, region A is this, region B is this, and then measure this, and then see whether you need to do further credit in those along those dimensions. So I just use that to explain. Then the next thing is there's a story, the mouse and the trap story. I don't know if anyone has heard about this story, but quickly I'll just give highlights of the story. So the mouse lives, of course, lives in the wall, in one hole, in the farmer and the wife. The farmer and the wife lives in that house, and then one day the mouse was peeping through the wall and then saw that the farmer came into the house with a bag and was assuming, was thinking that, oh, there must be food in that bag. He was already rejoicing that, oh, there's food again in the house for me to go and buy it in the night. However, when the farmer unwrapped the bag, he then saw that it was a trap that the farmer bought, and he felt sad that this farmer wants to kill me by this is. So he also started singing his own song, End Farmer, End Trap, like the end SARS that we have at the moment. His own song was End Trap. So he left, he was dejected, and then as he crawled back into his hole, he went into the farm and then met with the chicken and then told the chicken that, oh, chicken, can you imagine? The farmer has brought a rat trap into the house to kill me. The chicken said, oh, sorry. I mean, you know, it's a trap for the mouse. It can't actually affect me. So I'm so sorry. I wish you all the best. And then the chicken left and left the mouse to his dilemma. The mouse then met a pig also on the way and told the pig the same story. And the pig said, rat trap. Rat trap I have no business with rat trap. Rat trap is from people like you. So my friend, just find a way to deal with it. And the pig also left. And then the rat, still in a state of sadness, met a cow and then told the same story to the cow. And the cow said, see, I have more problem than all this one that you are saying. I have no business with this, your rat trap. Go and manage your problem. And so the mouse was left on his own. Unfortunately, that night, the farmer set the trap, and then a snake was crawling into the house looking for something to eat in the middle of the night. And the farmer and the wife slept on their mats in the room. And the snake accidentally just tripped the tail of the snake, touched the rat trap, and then the rat trap just snapped and then caught the tail of the snake. And in anger, the farmer's wife. And so the farmer was disturbed, and they managed to kill the snake in any way. The snake was not even the issue now, is to deal with the farmer's wife who was ill. And in their tradition, usually when someone is sick and has been believed that chicken soup is a good way to deal with that kind of sickness. So the farmer went into the backyard, picked the chicken that the mouse told about the rat trap, killed the chicken, and prepared a soup for the wife to eat. Are we together?
Yes. We are, sir. Most of them are on
okay, great. I want to be sure that we are still together. So, thank you. Yeah, I know we are muted. Just to be sure that network has not yanked me out again. That's why I was asking that question.
Yeah, we are.
So they cooked the chicken that ignored the warning of the rat. They kill the chicken, and then the farmer cook the chicken for the wife to, so that maybe if the wife take the chicken soup, the wife will be better. The wife took the chicken soup. Unfortunately, she wasn't getting any better. After some days of sick, the wife eventually gave up. No, even before the wife died, the farmer, because he had to be attending to the farmer, he attending to the wife. So because he had so many guests in the house, he had to then look for something to entertain them. And the next thing the farmer took was to kill the pig so that there would be enough meat for everybody in the house. That's how pig, the second person or second animal that was warned, also went for it. And eventually, fortunately, the wife died. And after the wife died, there was a need to do burial. You know, when they do burial, they invite a lot of people. And the next big thing was the cow to entertain everybody. And so that's how the three of them, those three animals died. And the rats, the rats itself was still alive. And the moral of the story is that do not think that the delinquency that is affecting Bank A will not get to you, or the delinquency that is affecting Sector A will not get to Sector B, or the delinquency or that risk that is imminent or that is already manifesting in one area will not come to you. So don't think it does not concern you. It concerns us all. That is the moral of this story. I don't know if anybody has any other moral from this story, apart from what I have just said. Any other moral before I move on to the next slide?
Do we have any comments?
Any other lesson? If there's none, I will just proceed.
Okay. You can move, sir.
All right, there are so many dimensions to this. Risk, credit risk, operational risk, market risk, financial risk, government risk, all of those can affect any one of us. Like I said, when we started this year, nobody foresaw all the events that will happen this year. We all started the year, we were optimistic. In fact, the year 2020, you know, especially for the religious people, we say 20, that 20 because it's double. All the blessings will come in double. Double this one, double this one. There were so many prophecies, so many things. Thank God for our lives anyway. But nobody foresaw that we will have double issues this year. We had COVID, as if COVID was not enough. Took everybody away, kept us at home for 3 months, and we are even still recovering from that. And then all of a sudden, NSAS also joined now, and we don't know how long this one will last. We also do not know what is still ahead. So many things can happen that can change our story, that can affect every one of us. So it concerns all of us. Now, what are the early signs that you should pay attention to in portfolio, when you see your portfolio, to show that some are defaults or to meet with conditions? In fact, before disbursing the loan, right? There are certain conditions precedent to draw down. Where I work currently, one of the conditions precedent to draw down must pay equity contribution. Also do it could be 10%, it could be 20% of it. To pay equity contribution, that's a debt research. When you have approved loan for someone and that person has not, if the equity contribution is 10% and the first 100% plus your interest. Another example of conditions precedent to drawdown is finding guarantor.
Okay. Network is a little bit bad where Mr. Adeomi is, but we'll just be a little bit patient with him, please. Okay. Let's just give him some minutes to come back in. Okay, let me try and call him personally.
Sorry,
Okay,
just bear with
the network.
our network.
All right.
We'll be reconnecting as many times as it is connecting us. Don't worry. That's a risk on its own. So we are managing that risk also.
Thank you.
So I was saying that another condition precedent to draw down is finding guarantor. If you find a customer who is finding it difficult to get a guarantor, be careful. That customer may not have good credit history or may not be credit worthy. If you can't find one person, one or two persons who will stand in for you, then that person may not be in a good position to pay back your loan. So there are so many things. So when a customer is not able to meet conditions precedent to draw down, know that there is a problem. And then when the customer starts defaulting in repayment, already that's a sign of delinquency. His due date is not meeting the repayment of due dates. He's coming up with so many excuses. You know that there is a challenge there. Also, when repayment cash flow begins to differ from the original drawdown repayment cash flow, if someone is supposed to be paying 40,000 naira every month, for instance, and then he says, okay, please let me pay 25,000 naira today. I will balance the 15,000 naira by second week. Already there is a problem. So you need to start tackling such issues and quickly identify how many customers do you have in that category and begin to manage them aggressively before it expands beyond that. You know, the challenge with lending is that your laxity or your toughness with customer A will affect how customer B will behave. They are each other. The microfinance bank, but everybody knows that if you borrow from that microfinance bank, you're not likely to just default and get away with it because people have shared their experience with other people. So what I'm trying to say is once you start seeing that sign, or it becomes an habit or it becomes a trend. One person's habit might become a trend if you do not need that habit in the board. When customers to meet up with repayment of principal and interest on scheduled date. And then when customers begin to ask you that, oh, can you extend, can you restructure for me? You know, there's a problem. Yeah, there are genuine requests. I mean, there are genuine reasons that may warrant restructuring. There are genuine those reasons are genuine. That's the delinquency that you are seeing. When customer is also unable to pay even after moratorium, that's a challenge. And then I need to quickly speak to moratorium. You need to be careful in granting moratorium to customers. It is not every business or every sector that requires moratorium. Moratorium has also the possible delinquency if it is not properly timed. If the moratorium that someone requires is 1 month and you give 2 to 3 months, you already create room for that customer to default because on 1 month after the expiration of the 1 month is that idle cash, temptation to use that idle cash for personal needs may arise and then diversion will happen. So you must be careful when granting moratorium. You must ascertain that moratorium is required, and you must also ascertain the length of time that moratorium should be. If loan is also for a specific project, when the defined completion period begins to shift, let me share an experience with you. When I was in the microfinance space, I packaged a loan for some contractor who was executing a building project. It was a revolving loan sort of. So it was, I think, in 5 million. He pays down on 5 million and then he gets another tranches because we were financing that project in phases. Once he reaches one phase, he will get the payment and then he'll pay us. And then I noticed he got a phase or milestone and then he started telling us story, oh, they have not paid him and everything and all the rest. And I went to the business that's gave him that contract to find, and they said they already gave him check. So mad, and took him up and challenge you, and then I got to know that he had taking the money and he was trying to divert it. So we took his case up, and then he went to court. Before I left that microfinance bank, I don't know it's a project, and the project timeline, negligence or deliberate action, or as a result of the people that give the customers the work, already also know that there is a challenge. Because if the timeline begins to shift, it means that the payment terms also will begin to shift. Extension of repayment tenure, variation of original loan conditions, disbursement of additional funds. When you begin to refinance or to the loan, when a loan is bad and you are topping up the loan, it's a challenge. It also is a sign of delinquency. And then when you then have projects that are jointly managed, you need to be careful in financing projects that are jointly managed. It's either you finance both partners or all the partners in that project, or you have a clear written agreement on memorandum of understanding on how the terms will run, so that your loan will not, your finances will not be at risk of being lost completely. Then you must also find a way to look at alternative source of repayment. That's why when you are profiling customers, you don't just profile the customers based on their business capacity. You're also profiling the customer. I believe we all know the 5 C's of credit. So there are 3 C's that are financial, and then there are 2 C's financial. The financial ones is about the capacity, capital, and then the collateral. Capital, capacity, collateral. Capital is the business capital itself. Then capacity is what is the ability of the business to generate enough turnover to repay the loan and meet its other obligations. You're also looking at collateral. Other things can you fall back on turnover to meet its loan obligation? So you must, in booking the loan, you must be sure that you have considered that in case there is a of capital, what else can we fall? That's the financial C's, the 3 C's. The non-financial, looking at the condition, the business environment. So you are looking at the character of the borrower. These 2 things, right? Good character, and also the environment is on to a business. You all agree with me? If you do not agree, just say, as a high rate. Do you agree with that? I was saying that a loan to a business in Mushin, I asked the question that do we agree that a loan to a business in Mushin has higher risk than a loan to a business in Ikeja?
Yeah, Bodron actually answered.
Do we agree with that assertion? If you agree, say yes. If you do not agree,
yes, I agree.
oh, someone answered.
Yes,
okay.
I agree. Yeah.
Why do you agree?
I don't agree. For me, I don't agree. That's not true.
I don't agree as well. Oh.
The reason why.
Okay, please. Those who do not agree, those 2 people do not agree. Just let me hear your reason why you do not.
My reason is very simple for me.
Quickly.
Ikeja is a government residential area, and Mushin is a commercial area. Very productive for any individual to be able to generate the income that will service the loan. Simple. Unlike Ikeja, you have people coming as far as state to come and Ikeja. And once they your loan facility and they leave that vicinity, your loan is bad already. So those are my own reasons.
Okay, thank you. Thank you. Your point is noted. The other person that doesn't agree to, what's your own reason?
Hello?
The other person that does not agree, what's the reason? Hello, yes, go ahead.
Okay, well, I was not the one that spoke earlier, but of course I do not agree because I think the chances of the loan being repaid has to do with sometimes the sector and the sector of the business, and of course what's it called now, the cash flow. So if you look at some sectors of businesses are more profitable in Mushin, why some sectors might be more profitable in Ikeja.
Okay.
So as such, if you're looking at sector by sector, you cannot have a direct answer to that.
Okay.
Yeah.
Okay, thank you. So let me just quickly attend to that. Thank you for those beautiful submissions. Now, if you look at the 5 C's, right, all things being equal, the two businesses are similar. They are in the same sector, but they are located in two different locations. The reason why I said the risk in Mushin is higher than Ikeja is the chances that riots will break out in Ikeja is lower than the chances that riots will break out in Mushin. In fact, in some parts of Mushin, you can have weekly crisis.
Yeah.
Ikeja is close. Ikeja is even the heart of Lagos. That's where the government, you can't have riots anyhow in Ikeja.
That's true.
So that I was just trying to speak to those 5 C's, especially the condition. So when you are booking loan, you don't just look at all of those cash flow alone. You also look at the condition, this environment, how stable it is. Even the business, is a shop located in a legal place? There are some areas you hardly find places or cases where government will say they are demolishing houses in Ikeja because it's planned. You can't even build in Ikeja without getting some, but you can get away with some buildings in Mushi. And your focus should not be on why is delinquency increasing. If you try to find out how can we eliminate it instead of saying why is it increasing, just focus on how can we eliminate or minimize it. That should be your focus, and that's what is called delinquency management. There is no lending institution across the entire globe can boast of 0% default. The Grameen model, where the borrowers are also shareholders, you still find defaults. So you can only minimize it and keep it as low as possible. That's what delinquency management is all about. And so measuring risk, so risk appetite also is a function, is also affects your delinquency management. What's your risk appetite? Some organizations, their single obligor limit is high. They can do as high as, but I think there's even a CBN policy on that, 5% of your shareholders fund. It shouldn't be more than that. I don't know if that has changed, but some even take risk and do a lot more than that. So you must also measure your risk appetite and determine what exactly should be the maximum risk loan you want to give out. What exactly should be the maximum tenor you want to do. Your risk appetite will speak to a lot of things. The tenor, the loan size, the kind of businesses you are going to be financing. Some businesses don't, some microfinance institutions don't finance agri businesses. We started financing agri businesses before, or we were financing agri businesses, but there are certain sectors or subsectors or some of the value chains right now that we have stopped financing because of the learnings we have, the results or the impacts we've seen in those sectors. So you must also know your risk appetite along these various dimensions, and then your risk exposure also. This describes the extent to which an entity is vulnerable. It describes your vulnerability in terms of risk. And this is determined by determining, this is measured by determining the potential, the probability of default on a loan, and then the maximum loss that you can incur if that default, if that default materializes. So probability of default multiplied by the potential loss will give you your risk exposure. So you must be able to do this, measure all of this by sector, like I said, by subsectors, by regions, by states, by local governments, by every dimension possible, even by gender. Statistics have proven that women pay back better than men. So you may want to skew your portfolio and say we'll do more of 60% of our portfolio will go to women and 40%. So that's a way of managing your risk also. And 40% will go to male gender. Age bracket also. You find that people who are elderly, they don't want to be messed up. So they are afraid, they don't want any wala. A lot of people are going about, they carry a lot of health issues. People don't want to work with them. Sorry, any comment?
No, you can go on, sir.
So a lot of people also, the elderly, they are above, all right, the 18 to 35, They are still at the early age of their life. So they just feel that I can borrow Jari, and then 50s, you are careful. You don't want wala, you don't want people to start shouting on you because of high blood pressure and all the rest. So you want to pay your loan as much as possible. So all of this, you have to also put it into consideration in developing your loan portfolio. Risk elements, measure risk. We should always measure risk exposure. Rather, we always tend to manage it. So if you do not measure, what you don't measure, the truth is what you don't measure, you cannot manage. So measure it before you can even manage. There's nothing wrong managing risk exposure, but the first thing is measure it. And how do you measure? I said determine the probability of default and then the maximum loss that you can incur. Multiply that probability by the loss that you can that you are exposed to. If that risk materializes, that will give you your risk exposure. So this is a case study. Quickly, we'll look at this, and I want us to make comment before we move to this second segment. XYZ Microfinance is a well-known MFB that has served the local community in which they reside. They have been around they have done so well that between 5 years, they are able to open 10 new branches across the state. But current situation, the board of directors of the MFB decided to change the MD because they refused to go against laid down policy of the regulatory authority. Apart from that, 2 persons from the BODs had previously had issues with the MD for personal favors they requested for, which the MD deemed unethical, and then he refused to grant their request. They wanted him to recruit some candidates who were not qualified to take on the job. Eventually, they had him leave the MFB, which he had been managing fairly well. Now, the problem is that with the employment of the new MD, the portfolio of the MFB grew from bad to worse, and staff attitude to work also changed. Due to reduction in staff welfare allocation, the bank's equity has been eroded, and the regulatory body is requesting the MFB to recapitalize. On a supervisory visit, it was confirmed that loan disbursed to some clients were shared by the loan officers. To make matters worse, one of the directors is proposing replacing the new MD. Problems don't just fall from the sky. So who created these problems and what should be done to remedy the current situation? Comments? Who created the problems? Where did the problem start from?
Let's speak up, please. There's a problem on ground. Hello, are we all thinking?
Solve this problem, please.
Hello.
Hello, Sammy, please, let's hear you.
Who wants to go first? Okay, Sammy, please go ahead.
All right, sir. Thank you, sir. I've been very much interested and happy with your teachings all along. For me, I see the shareholders of the company derailing from the policy of the MFB itself. And as part of company policy, business is different from its owners. And an MFB that has a vision or mission statement, this should be what every worker, be it management and the owners of the business, should pursue in order to achieve their goals. So seeing them,
okay, go ahead.
I mean, challenging the decision of the MD in driving home the mission and vision of the bank, I see automatically the business is going to collapse. And where you see people bringing in unqualified people because of favoritism or godfatherism into business, automatically this is a risk element. And if you are not a risk taker, it's either you are a risk averter. So in as much as the MD has deemed it that he's trying not to take those risks, and he's being asked to drop down.
All right,
for the situation.
Thank you. Any other comment?
Well, I see.
Sammy, let's hear another person. Thank you, Sammy.
All right,
let's hear from another person.
Okay. First of all, the company has corporate governance issues. The moment there is
I like that word. Please, thank you so much, Abodin. I was looking for that word. Corporate governance issue. Go ahead.
Now, as at the time, when it also has conflict of interest, because you have vested interest in certain candidates you want to bring in, and that's also that's also part of the governance issues. Again, because at there's what we call tone at the top. Once tone at the top is not strong enough, it has a trickle down effect on all the employees up to the least employer, and that's where compliance issues also comes in. So as a result of that, it also tickled to the effect of operational issues where you have employers not doing what they're expected to do. There's indiscipline, there's at the top. So once the top is not so sound, they can't drill down such compliance issues up to the bottom. So that's my take.
Thank you so much, Abodri. All right, so this I agree. I mean, both
to talk since can Mary Sylvester hear me?
Sorry?
Answer this question.
I wanted to say it's been men and men and men all this while.
Exactly.
Okay, maybe please, maybe you can address the second issue. You can also speak to the first question. Please, Mary, the floor is yours.
Mary Sylvester, can you hear me? Mary. She has been raising her
Mary
hand.
Sylvester, you can go ahead, please.
Mary Sylvester.
Oh my God, so sorry. Apologies for that.
Okay, well, maybe when she's ready, I'll just give her a chance.
Okay, all right. So the two contributors actually nailed it. The major issue here is the corporate governance issue, and that issue then nosedived or created other issues around poor HR management, poor credit control, conflict of interest, and all the rest. And all of this then was what created the situation where they are, where they are right now. And what should be done to remedy the current situation is first to address that corporate governance issue. That's the root cause analysis. Let the board of directors focus on providing strategic oversight for the company. All you need to do is to ask for periodic meetings where you then assess the performance of the organization and give direction, chart direction for the organization. You are not meant to interfere in the running of the organization. And even if there must be insider-related loans, there's a percentage of such loans that is permitted by CBN, and there's also you must declare interest if you have any insider-related loan, that this loan is coming through me, and you must be held accountable for such loans, so that you don't just, and then staffing, there's a procedure for staffing people, for selection, recruiting, and engagement and managing. That procedure should be properly followed. If anyone is not qualified, there's no way, whether it's from the MD or not, or from someone else, they shouldn't impose such person on the system. But Nigeria businesses, these are some of the things that kill Nigeria businesses, and I believe most of us are managers or maybe even senior level people. We should avoid finding ourselves in situations where we have to compromise because it's someone that is related to you. We want to give credit. Where I worked, I've been able to help a number of people that are close to me, but I always declare this person is, I may not be related, but I know this person. So it's like I declare upfront that this person. So they tie those loans to me, and it just puts some pressure on me to ensure that those loans are paid back. So that's the way, this is what this case study is speaking about. Corporate governance issue, HR issue, compensation issue, recruitment issue, even credit control. So let's move, because of our time, to the next slide. I think we should be going to the next slide that speaks to the second. But there are certain clauses around it. So one has to be very careful. You must be sure of the amount the person is owing. You must be sure that you have followed all the steps to recover that loan before you execute, because there are penalties for financial institutions who wrongfully implement GSI. So it's not something we should just rush and go. Be sure of your facts before you proceed to do it. So It's meant to serve as a last resort for creditor bank before you take someone to court for not paying. It's just meant to serve for the creditor bank to be able to get to reduce past due obligations in their book. And culture, when people then know that GSI is in place, if I borrow in Ibadan, I cannot even, there's no way I run to. If I have accounts in Lagos or in Abuja, they will sweep that account to repay my loan. People then begin to have good credit culture. They begin to have this sense of responsibility to pay whatever they are borrowed. It is where there is no law that you have lawlessness. It is because our credit system is still not firm enough that people borrow from Bank A and borrow from Bank B and then goes around borrowing from everywhere, becoming a predatory borrower for microfinance bank. But when the news, when we keep tightening the news, everybody that borrows will upload their details on the credit bureau, such that if you go to borrow, so once they see your record on credit bureau, you are not, it shows your record, you won't be able to get credit. And then once you also know that your loan, you will always pay it back one way or the other, unless you don't want to fund your account. It also helps to reduce the non-performing loans in the banking industry. And then it helps to watch list consistent loan defaulters. So those are the three main objectives of GSI. And the stakeholders, of course, you have the borrower, the creditor bank, the participating financial institutions. You have to sign up with to it to participate in it. And then Nigeria Interbank Settlement System, NIPS, because these are the ones that actually implement that settlement. It's more like set off. You set off one bank balance against another bank balance, and this is done through NIPS. Of course, CBN is a regulatory body, and the eligible account types for GSI: savings accounts, current accounts, dorm accounts, deposit accounts, even in Naira and foreign currencies, and now electronic wallets have also been included. So if you have electronic wallet, because all of these are linked to your BVN, so as long as you have one BVN, I know that as of today in Nigeria, it's difficult to have multiple BVN, in quotes anyway. I understand that some of those politicians have been able to get away with it, but the large majority of people have one BVN. So as long as that BVN is tied to that account, you cannot escape repaying the loan. So that's what GSI basically does. This is just a pictorial representation of how it's done. The digital recovery that is happening, borrowing from institution A and taking your balance in institution B to set off your balance in institution A. That's all this slide is speaking to. How it works, like I explained, you must be a financial institution duly licensed by the CBN. You must have adequate information technology infrastructure, because there must be interconnectivity between your bank and NIPS and the CBN so that all of this setup can happen. So you must have proper IT infrastructure. You must also provide access to the customer's NUBAN account. And then you must execute the GSI master agreement with NIPS, and you must also ensure that the customer signed GSI instruction or letter agreement before taking the loan. Otherwise, you won't be able to do all of this. GSI is more like set off. You can use set off for it. And I think it's only applicable for loans generated from August 2019, if I'm right. So any loans before that time, you cannot implement it. So if you and they are past due right now, you created those loans from 2019 August up to this moment, you can implement GSI if you have the set-off agreement signed by the borrowers. So that's what GSI. GSI also helps you to reduce your delinquency or portfolio at risk. And this is something that the sector has welcomed, because it will really help to improve credit culture of Nigeria.